Tomorrow is the Walt Disney Company earnings call, and Bob Iger, Josh D'Amaro, Christine McCarthy, and even Kevin Lansbury have indicated that the theme park segment, the highest revenue producer for the company, may be failing for the second quarter in a row. But Wall Street doesn't seem to care about that. They only seem to care about streaming numbers. Those aren't doing very well either, but let's talk about that anyways here on That Park Place. Hello, I am Jonas J. Campbell, an investigative reporter for That Park Place, and I like to talk about the numbers. I don't know if you know this, but I have some experience in the finance realm. I was more on the accounting side as opposed to the stock market side, but something interesting has come up, and my co-host Vash pointed it out to me, that Wall Street does not seem to care about theme park revenue. Comcast has shown rises in revenue quarter over quarter in their Orlando and Hollywood theme parks, and they've even got Epic Universe coming up soon, and that doesn't seem to be a growth sector that Wall Street is focused on. With the recent news that Six Flags and Cedar Fair, owners of Cedar Point, will be merging in order to create a company that they intend to be more competitive in the theme park space, they don't seem to be doing fantastic in their stock price either. Theme parks are traditionally considered a cash cow because once the physical plant is there, all they have to do is get people in the door. Well, we assembled a panel of experts to talk about this, and as we like to do, we brought the data to talk about what actually drove the Walt Disney Company stock price to go up and what caused it to fall, despite theme park revenues going up. Well, let's get to it. Investing in theme parks, maybe from a day trading standpoint, is probably not a good idea. This article from Blue Loop says, has Wall Street grown tired of theme parks? With Q3 results on the way for major theme park chains in the U.S., the markets have already been reacting. During the peak of the pandemic, a common message was being spread by many financial investment firms. They felt that in the years that followed, there would be an explosion of interest in visiting theme parks due to the lockdowns and travel restrictions. This would result in a tidal wave of profits like nothing ever seen before. That's fascinating. So we don't talk about Six Flags a ton unless we're comparing them to other parks, but Six Flags announced that it would be releasing its Q3 2023 financial report on November 9th. Since then, the company's stock price has actually steadily declined, like the first drop on a roller coaster. I see what you did there, Blue Loop. Very good. Daily financial reports say Six's price dropped 7.25% alone on Friday. Cedar Fair announced theirs, and they're at 35.08 as the publishing of this article, and it's just a hair above the chain's overall 52-week low of 34.35. SeaWorld, which I didn't realize until this, that SeaWorld was off on its own. For some reason, I thought they were owned by a different company. But SeaWorld closed at 48 and just above the company's 52-week low of 42.24. Disney and Universal, they're obviously set to release their earnings on November 8th. Disney's financial calendar, as we all know, is different than most companies. Upon this announcement on October 1st, Disney's stock price saw a brief rise for about a week, only to begin its steady drop. And where's Comcast in here? There they are, covering Comcast. Comcast stock price closed out on Friday at $42.86. It's actually closer to the company's 52-week high price of $47.46 rather than its 52-week low of $30.04. Comcast's performance isn't only based on the success of its theme parks. So this was the fascinating thing, just to get very specific on Comcast. Comcast announced that they were doing really well, like I wanted to say another 17% rise in theme park attendance, and that is successive quarters of theme park growth there for Universal. That being said, their normal segments, which are broadband, because Comcast is primarily a broadband utility. They have video, which when we say video, we mean cable, what would have been called cable years ago. That segment is losing customers, and Comcast, their growth in the theme park segment, as juicy as that is from a financial standpoint, it seems like Wall Street is just not interested at all. Mike, why do you think that is?
That's a good question. I think we might have a couple things at play here. I think one of the problems or one of the challenges that happens in the stock market in general, and now I'm sort of speaking just as an observer, is that this isn't a sexy stock. It's not flashy, dashy. Theme park companies are going to give you hopefully stability. As an investor, they're hopefully going to give you stability, continuity, and in terms of dividends, regularity. It's kind of like let's go back to what made Disney great as a stockholder perspective. The thing that most Disney stockholders that are longtime stockholders going back decades will say is that it was not a very volatile stock. It was a steady stock, and you always got dividends. Sometimes they were great, sometimes they were okay, but you always got something. Okay. And that's generally what theme park stocks are supposed to do. But in an age where it's all about making money quick, having fast appreciation, technology, AI, sexy stuff, this is the least sexy thing out there.
Yeah.
From an investment and finance standpoint, and regardless of attendance and financial results, I think that Wall Street is not enthused about this type of making money over the long term gradually. That's my view. What say you?
The thing I would add to that, when you look down at the breakdown of revenue at the Walt Disney Company for a very long time, 2019, I would agree with you. 2019, the Walt Disney stock performed like clockwork. They had their ratios of debt to equity, their operating income versus their operating expenses. All of that it was almost as if they had tuned everything to say, oh, we don't want to be too profitable. Let's go ahead and spend a little extra money here in order to get it in line. Almost to the point where it's like, oh, whoever was running that company from a financial standpoint, Tom Staggs, was doing a fantastic job of keeping everything in line. And Media Networks was doing fantastic. And theme parks were doing fantastic, to the point where Media Networks was outpacing theme parks, which were a huge portion of the company. If the company was divided into 5 parts, one of them would have been film, and one of them would have been film, which never really made them that much money because it was an IP generation play. It was basically ads for their theme parks and for the television networks that they got to make a little bit of money off of. 2 parts would have been theme park revenue, and 2 parts would have been Media Networks revenue. Everybody following me so far?
Yeah. I got
Yep.
So something happened in 2020 that caused that theme park revenue to go into, let's say, questionable territory. But instead of the stock price going down, here we are in 2021. Here's where's 2020? Here's 2020. And there's a little dip right here around March. And look what happened going to February of 2021. What do we reach? We reach 189.04. The theme parks are not really doing that great. They're okay. But what is going on at this point?
Streaming.
And what are the profitability metrics?
Value, the speculative, that proves my point. That's the speculative value of Wall Street being bought into the sexiness of new technology and the streaming wars. And then reality catching up to the lack of sexiness and performance in the streaming wars.
Profitability.
Yep. So this is Disney going in and promising that they're going to spend tens of billions of dollars on making Disney Plus profitable, instead of the theme parks, which the theme parks at this point are maximizing the amount of profitability they get, because they're lowering their margins they're raising their margins as much as possible by lowering their expense as much as possible. Here they're charging for Disney Plus, they're doing all these premium experiences. They are raising that divide between somebody just walking into the park and dropping a few dollars on getting to ride a few rides. And I realize that's more, I'm not meaning to minimize how much it's always cost, because Disney's always been expensive, but now it is ridiculously expensive. Yeah. Meanwhile, they're begging for people to pay them. It started out as around $6, $7 to get a monthly subscription to Disney Plus. Meanwhile, they're spending $200 million per show in order to put these things in front of your eyeballs. This is insanity to me. The fact that people saw this Netflix growth, and Netflix is still doing fantastic. Last time I checked, Netflix is trading at $400 a share. And Disney right here, as the only thing that has lowered this stock price, appears to be Disney Plus.
I would. I mean, the only additionally, I mean, think about it. Everybody is now hearing all of the things that we've been saying were happening. Like theme park attendance is down, where it's attendance is up over at Universal. The sacrifices that they made with Project Gamma version 9 or whatever it ended up being, because you have a walk-through attraction that nobody's looking at. You have not exciting things that are in the parks, which would include the exciting roller coaster that they put in called Tron. That landed with kind of a thud. You have all these things you've invested in, and probably you spent your money poorly because you didn't have foresight. You had
Harmonious Galactic Star Cruiser.
Yeah, I mean, and it's like, well, we're going to base all of this on our version of the IP. Well, that's not the stuff that everybody wants to see.
Correct.
They've screwed up when it comes to what they choose to develop in theme parks. They are no longer going to hit home runs because they've chased off every good Imagineer that they have to other companies, and mostly Universal. And I mean, you don't, if you don't have a Baxter, if you don't have a Rhodey, if you don't have those guys and gals, there are a couple ladies in there too. If you don't have them, your attractions are going to suffer from that. The next best idea is not going to come from somebody who's not creative. And you know what? We've got nothing creative coming out of Disney. Nothing. So the theme park space has suffered because they've lacked any kind of foresight. It was even reflected in the plans for the latest version of Project Gamma, which is the redevelopment in Epcot that was supposed to occur. They've not only fallen short, they canceled projects outright. So there's very little being done there. And you have attractions that are failing. They can't afford to maintain the things that they have. So, I mean, I can go on to a laundry list of why, they aren't putting their money where they need to. And the last thing I'll say is the reason Tron took so long, imagine between the time that they were getting started with it and the time that it actually finished, wasn't just because of the global crisis we went through. It was because they were balancing every quarter with CapEx. They were watching those numbers so tightly that it was not in their interest to finish that attraction in a timely manner when it would have been even more relevant. Anyway, those are my thoughts on that. But.
No, you're right. They spread the development of a lot of these attractions out quarter to quarter. We're actually seeing that today with some of their stuff, like the Adventureland Treehouse, for example. Why is that taking 2 years? It's taking 2 years because it's like they don't want to allocate that capital past a certain point every single quarter, and it's ridiculous. On the flip side, when you talk about the creative engine of WDI, right? They ran out, like you said, all of the legacy Imagineers, right? They didn't have that institutional knowledge that was passed down from generation going to generation, right? Lake Nona scared a lot of people off, and so they pursued other jobs elsewhere. And the company had to fill its ranks with somebody who they got the, just straight out of college type guy who has nothing to his resume, nothing to his portfolio, who is only looking to add stuff to it in order to get to the next big job, maybe at a Gensler or somewhere else. The destination isn't WDI. It is simply a stepping stone. And this is why you're seeing, just fluky decisions, right? We saw, like, even when Tron opened, for example, like, we had that corridor, that hallway that, people were kind of tearing and just defacing, right? Because they didn't have any barriers, or they didn't actually, install the materials necessary in order to keep that wear and tear from happening on a great level. And it's like, well, why didn't we not think of that? We have 70 years of institutional knowledge developing theme parks. It's like, that's why, because you have nobody with those lessons in play right there. Jonas, to your point, when it comes to the over earnings, I mean, this is what the Restore the Magic campaign by Nelson Peltz actually said on the last page there. It actually talks about over earning at the parks division and how it's like, look, when you're nickel and diming people, when you're creating this perception that the parks segment is very, very copiously expensive, that nobody can afford it, that they're going to be nickel and diming you every step of the way, all of that, it's going to affect demand at a certain point. And I think that's what we're seeing today here. They really in the time that the parks were closed, Disneyland was closed for 412 days. They amounted massive losses from having these things closed. It was like, okay, well, let's just earn all we can. Let's add Genie Plus. Let's nickel and dime all we can. And the company, I think, got into some hot water right there. We're starting to see a pullback of that, but the underlying issues there and the decision makers as part of those things, they're still there. They're still in place, and that's why I think this segment's going to be hurt for a little while here.
I think that I think you're correct on the Disney side. There's a brain drain that's gone on at Disney, and I think Universal Creative has snatched up a lot of those people, the ones who want to stay local to Orlando and to Burbank and not go over to Ginsler. Although if Universal is smart, they're probably also using some Ginsler talent because they're perfectly willing, by the way, to just put up a roller coaster because it would be fun to have a roller coaster here, which is, I got to say, as much as I love great theming, is an advantage for Universal that they can just throw something up and it's fine. So Velocicoaster, they get heavy theming in the queue, and after that, what if we just had an awesome roller coaster? It's something that, okay, Disney does it quote unquote better, but Universal is able to get that thing up without as many strings attached. So it is a competitive advantage for both of them, where neither one of them wants to quite be the other in that space. There's only two things I would add here on the Comcast situation. Yeah. Comcast currently owns a streaming service, which is Peacock, and Peacock is not yet profitable, and it didn't quite affect their stock price. There's still going to be a little bit of loss for Peacock, but they seem to be playing that a little bit better. That one has an ad-based tier on it that can still be profitable for them in the near future in a way that Disney Plus probably will not. It's closer to profitability. And also, of course, Epic Universe is coming out in 2025. So there is growth in the theme park space for Comcast, whereas there's not so much growth available for Disney in the theme park space.
And we've seen double-digit growth from Comcast's theme park segment in the last 3 or 4 quarters, which is, when you're talking about a legacy business like theme parks are, to see double-digit growth in that segment, that's really something. Culture, you were going to say something.
No, I was just going to say, you actually, I think, mentioned that you're looking at a 17% increase in traffic in their parks, according to them on the last quarter. That's amazing.
Double-digit revenue
increases. Yes, 17%. Yeah, I was amazed. Yeah,
they're doing fantastic. Thank you so much for staying this far into the video. If you like what we're doing, please consider hitting the like button. I'd be remiss if I didn't tell you that I will be on the Valiant Renegade channel tomorrow, November 8th, for the Warner Brothers earnings call and also for the Walt Disney Company earnings calls that day. It's going to be a long day. I think I might also be appearing on the WDW Pro channel for a special edition of the Pro Show. Of course, subscribe over there for the specific details on when those live streams will be. Of course, share this out on social media if you know someone who might be interested in what we're talking about. And of course, if you are, then please subscribe to That Park Place for all the news that should be fun.
Thanks for watching That Park Place News. For more information, consider checking out www.thatparkplace.com. And don't forget to subscribe, share, like, and send this out on your favorite social media accounts.